Are you running a single member LLC and wondering how to pay yourself and handle taxes? It's simpler than you think, but there are some key rules you need to know. In this video, I'll explain exactly how to pay yourself from your single member LLC and how taxes work so you can avoid costly mistakes and keep things stress-free. I've helped hundreds of LLC owners optimize their finances and tax strategies, and today I'm sharing the steps you need to take. I'm Brad Paladini, and over the past decade plus as a tax attorney, I've helped countless business owners like you handle taxes and maximize savings. So let's first talk about how a single member LLC is taxed. So by default, a single member LLC is treated as a disregarded entity for federal tax purposes. What that basically means is there's no difference between the LLC and you yourself personally in terms of taxes. So the LLC itself does not pay taxes to the federal government. The tax obligation is on you, the individual. So when you go to file your tax return, as part of your Form 1040, your personal tax return, you will include a Schedule C. That's going to list all of your business income, all of your business expenses, and show what your profit was for that tax year. Based on that profit, you will pay two different types of taxes. The first is self-employment taxes. So self-employment taxes, basically it's a mixture of Social Security and Medicare. You'll also pay income taxes, just ordinary income taxes on the profit of the business. So that's how an LLC works. From a tax perspective, let's talk about how to pay yourself as an owner. The most important thing to keep in mind is to have a separate business bank account for the LLC. All of the business income and all of the business expenses are paid from that account. Most importantly, you are not paying your personal expenses from that business account. You're not paying your personal rent. You're not paying your personal car payment, your food, clothing. All of that should come out of your separate personal account. The business account is just for business. And this is something that I see time and time again people do incorrectly, and it can cause major problems in the future, particularly if you are ever audited. So keep the business account separate. Okay, so you have a separate business account, you made some money. How do you pay yourself? Really simple. All you need to do is write a check from your business account to you yourself personally and deposit that money into your personal account. Now, you could also theoretically do a wire transfer or something like that. But when I had my own business and it was a sole proprietorship, I would just write a check from my business account to myself personally so I could keep a tally of how much I was getting in distributions from the business, how much an owner's draw in total I was getting. Here's the key. When you take money from an LLC, it's not taxed. So it doesn't matter how much or how little you take from the business from a tax perspective. Because again, the business is only taxed based on the income and the expenses, right? They're going to look at the difference, the profit of the business, and that's what you're going to pay your taxes on. So let's run through an example, right? So year one, you make $100,000 net profit, you file your return, you pay your taxes on it, but you don't take any owner draws. You keep all of that money in the business account. Year two, you make another $100,000 net. Again, you file the return, you pay your taxes, but you leave all the money in there. Year three, you don't have as good of a year. You only make $25,000, but you decide, hey, I'm going to take an owner draw. I'm going to take $150,000 out of this business bank account. That doesn't mean you pay taxes on the $150,000. You've already paid taxes on that money in previous years. You would only pay taxes on that $25,000 of net income for that particular year. So you need to understand that regardless of how much money you take out of the business, you are still going to be taxed on the profit of that business. So that's how you pay yourself as a single member LLC. Let's talk about how do you pay your taxes. If you are used to getting a paycheck, right? You've always worked for someone else your entire life. You would notice on the paychecks, there are federal tax withholdings. And basically what that is an estimate of how much they think you are going to owe in taxes in a given year. And so that money is turned over to the IRS. And when you go to file your tax return, you figure out exactly how much you should owe. You look at how much was withheld, and the difference is whether you owe money or are due a refund. But when you have a single member LLC, there's no paychecks, right? If you're a single member LLC, you cannot pay yourself via a paycheck. It's just not permitted. Again, as a single member LLC, disregarded entity. So how do you pay your taxes? The IRS requires you to pay quarterly tax payments. So 4 times a year, you are supposed to send in a check or pay online and give an estimate as to how much you think you're going to owe in taxes for a given year. Now, you can base that on different things. So if you've been in business for a few years, you could take a look at last year's tax return, figure out how much in total tax you owed for the business, divide that by 4, boom, you got your estimated tax payments. I don't recommend that strategy for any of my clients. Instead, I recommend to all of my clients who are self-employed with a single member LLC to make monthly estimated payments. Why do I suggest monthly and not quarterly? Well, let's say you owe $12,000, or you think you're going to owe around $12,000 for a year. If you go to pay that quarterly, that is $3,000 every quarter. And if your business is new or maybe not that large, $3,000 at any given time can be a big chunk to pay. But if you're paying it monthly, only $1,000 a month, you can manage the cash flow much better, much more easily than if you tried to make those quarter estimated tax payments. So I always recommend monthly payments. Again, you can calculate based on whatever you owed last year, or my preferred method is to just take a look at your profit and loss on a monthly basis, see how much of a profit you had for a given month, look at what your effective tax rate was last year, and then make a payment based on that. Now, if you pay too much, so let's say you paid in $15,000 for a year and you go to file your tax return and you only should have paid $12,000, you'll get a refund of that $3,000. On the flip side, if you're short, so if you paid in $15,000, but you end up owing $24,000, you're going to have to come up with that big chunk of $9,000 or face pretty substantial penalties for paying late. What are other options available? Maybe you don't like this setup of not getting a paycheck. You don't like having to make all of these estimated tax payments, and you want to know what some other options are. Well, if you have an LLC, you could elect to be treated as an S corporation. If you're an S corporation, you are required to pay yourself a reasonable salary. So now you would go back to getting a paycheck from a company, now your company, and it would have withholdings. So let's say the business makes around $100,000 a year, and you decide that a reasonable salary is $50,000 a year. You can have taxes withheld every single paycheck in anticipation of filing next year. Now, I have an S corporation, and how I handle this is I have more withheld than someone making $50,000 a year would ordinarily have withheld. Why is that? Well, because yes, I'm paying taxes on the $50,000 in wages, but if I anticipate $50,000 in profit on top of that, I'm also going to owe taxes there. So if you have more withheld from your paycheck, you can kind of avoid having to make those estimated tax payments because it's already being withheld from the paycheck. I've had some clients in the past that just had the government withhold their entire paycheck. So every single paycheck, they would get paid, let's say $2,000 per pay period, and they would have the entire thing withheld. So that way they didn't have to worry about making estimated tax payments. There are other benefits to having an S corporation as well. We talked earlier about self-employment tax. S corporations can help limit the self-employment tax that you have to pay. We'll talk about that in another video. If this video is helping you understand how to pay yourself, please take a moment and hit that like button. It really helps other business owners find this information. And if you're ready to optimize your LLC's tax strategy and ensure you're paying yourself the right way, click the link below for a free consultation. my team and I will help you save money and avoid these common pitfalls.